So my name is Ruth Beddoes and I'm the Managing Director of Global Capital and Euromoney Conferences, and with me today is Chin Chin Koh, Managing Director of UOB from Singapore. Non-Eurozone's issuance activity has seen a big change in H2 versus H1. What are your views on why this is the case?
Yeah, I think the overall global covered bond issuance, I think particularly for Q1, actually it was like more than 30%, more than what was done last year. Okay, but however, if you look at the subsequent quarters, it has been declining, and I believe that the trend will continue. Now let's talk about why there was so much issuances in January, early part of the year, because you knew that in last year, Q4, we actually had a market sell-off, and then that was followed by significant market volatility as well as, spike in the senior unsecured spreads as well. So therefore, definitely it's more cost-effective to actually tap the covered bond market for cost-effective funding, as well as it's a more insulated or more stabilized market. Yeah. Then I think looking forward, I think of course the market become more, rate environment become more negative, right? And I think that has also impacted investor demand, then consequently the potential supply into the covered bond market. Yeah, and the other point is really on the regulatory front, because I think a lot of the banks will have the MREL buffer requirements as well as other banks with TLAC requirements. So for example, the Australian banks, I think the APRA has just announced in July where they have to fulfill the TLAC requirement with the Tier 2 securities. Right? Canadian banks will also need to fulfill the TLAC requirement with the bail-in papers as well. So that's why at this point, they will tend to focus more on those requirements as opposed to a pure covered bond funding. Yeah. So I think structurally, I believe that the supply will become less.
Thank you. And leading on from that, the biggest theme in Europe right now is negative yields.
Right.
What are your views?
Okay, I think this is the rate environment will continue to stay. So I think what we need to adjust is more our mindset mentally. Yeah. So that's because I think the monetary policy easing is the way, I think, the response to the slower global economic growth. So I think the rate environment will continue to be in this manner. The question that we always ask is, will the investors continue to actually buy negative yielding covered bonds? And I believe that while that should be construed in the context of the investors' liability profile and their objectives, I do generally believe that investor demand will shrink. Why? Because some investors simply can't buy negative yielding assets, right? Even they try to push out the maturity, but to what extent can we push it out? It's not sustainable. And also it may not fit the balance sheet structure of the issuer as well. And some investors are also looking out to redeploy to other higher yielding assets. Yeah. However, for covered bonds, we do have a group of investors called the bank treasuries. They have to maintain LCR requirements. So while some already have built up liquidity buffer ahead of the more negative environment, but there are some, it's very heartening that receive initial feedback from some of the investors that they continue to be looking to diversify into the non-Eurozone papers like ours, Singapore covered bonds. Since the CBPB3, they have been looking at that and they are continuing to do so. Why? Because Singapore covered bond is continuing to be a high quality paper, and it gives you 15 to 20 basis more yield picked up than the core Eurozone papers as well. Yeah.
Thank you very much.
Thank you.